What up, guys? Welcome back to my channel. My name is Godfrey. Good to have you again. Now, today we are breaking down one of the most important parts of understanding how forex traders stay consistent and organized. Whether you are curious on about how forex works or you just want to understand how successful traders structure their strategy, this video will walk you through the core elements of a solid trading plan, step by step, in a simple and beginner-friendly way. A trading plan is a written document that explains how you should trade. It prevents emotional decisions and keeps you consistent. So grab a notebook, get comfortable. Let's dive into the foundation of smart, structured market learning. So when writing your trading plan, it should contain the following criteria. Your number one criteria there is you should set your trading goals. The one there is trading goals. Your trading goals give direction and prevent you from overtrading. What goals are we talking about? You might say, okay, on my daily target or my daily goal should be okay. I'll be securing $50 every day. I'll be securing $100 every day. I'll be securing $1,000 every day. I'll be securing $10,000 every day. So it depends on your daily target, which is your daily goal. So your daily goal should lies on what? I want to grow consistent, not chasing hooked wins. But it's okay, I'll be closing at $10 every day. So far, that one is okay by you. Now, your weekly goal there is what? Journal all your trades for the week. That should be your weekly goal. Journal all trades and review your mistake every week. Then your long-term goal should be like, I just want to become a disciplined and consistent trader. That should be your long-term goal. So that's just it. So goals focus on process, not just money. So your number one criteria in writing down your trading plan should be your setting your goals, your trading goals. Number two is what? The pairs you trade. Trading fewer pairs increase focus and accuracy. Me personally, I always trade gold, SAUUSD. That is what I always trade, and I focus on it. Before I was trading GBP USD and gold, but I decided to focus on gold, and since then I've been consistent in profit. So trading fewer pairs increases what? Focus and accuracy. We might decide, okay, I'll be trading only Euro USD, GBP JPY. Okay, so because each pair behaves differently, when you specialize on a particular pair, you get better in it and you can easily predict the movement of that particular pair. Number three is your trading session. No, forex market runs 24 hours every day, but not all hours are good to trade. So that's why it's good for you to set a trading session for yourself. Like me, I always trade London sessions. So we have London sessions, we have New York session, we have the Asian sessions. The London session has the high volume. The New York session has the biggest movement in the market. The Asian sessions, they are slower and sometimes very calm. So I personally trade London session. If I don't see any setup on London session, I'll wait for New York section and observe the market. If there's a clear setup to enter, I will not enter for a trade. But if I'm not able to find any setup on both London and New York session, then I'm done for the day. No need of stressing down to a Asian session. So it's very important for you to pick a trading session in your trading plan. This prevents random trades at bad times. So number four is your entry rules, very important as well. Your entry rules explains exactly what must happen before you enter a trade. You cannot just open your MT5, MT4 or your trading view and start jumping into trade. Something must happen that will give you a confirmation for you to enter that particular trade. For example, your market structure formations, your indicator or your chart pattern, the time frame you are going to be using. Let's say, okay, I want to be using 15 minutes time frame as my entry. I want to be using 30 minutes. Some even use 1 hour, some use daily time frame. So now you must also be looking at what invalidates that particular trade. If you are waiting for an entry to happen, there are some things that will be seen as, okay, this setup is no longer valid. So those ones should be your entry rules. For example, I only enter market when the structure is bullish. And when I observe there is a price pullback to a demand zone and I see a bullish candle for confirmation, with that I'm okay and I can jump into that particular trade. So number four is very important. You must have your entry rules in your trading plan. What do you see before you enter that particular trade? Is it a candle formation? Is it a chart pattern? Okay, is it the indicator that is telling you to enter? So what do you actually see before entering that trade? You must have a reason for entering a particular trade. You don't just jump into a trade like that. So it's very, very important. Set your trading rules, your entry rules in your trading plan. So number five is your exit rules. The same way we have our entries rules, we must also have your exit rules. Now, you must know when to leave a trade before entering that particular trade. From your setup or from your maybe when you are in a buy position or sell position where you start seeing rejection candles or chart or reversal patterns, you should be warming up to leave that particular trade. And your exit rules must contain your stop loss and your take profit. So your stop loss protects you when the market goes against you, and your take profit helps you to close your trade when you are in profit. For example, my stop loss must always personally my stop loss must always be behind the last structure point, and my take profit must be at the next major level. So that is how I pin down my exit rules in my trading plan. Number six is your risk management rules. Your risk management, very important. This is the part that saves you from blowing your account. So when writing your risk management under your trading plan, you must decide how much percentage are you going to lose per trade. How much are you risking per trade? How much percentage might say, okay, I want to lose $1 to $2 per trade. I want to lose $5 per trade. And you must also decide your maximum risk for the day. How much are you going to lose for that day? Your maximum loss for the day. You might say, okay, I want to. Personally, I always tell my students, don't risk more than 10% of your account size. Let's say if you are trading with a $100 account, 10% of $100 is $10. So if you are risking $10 every day, it will take you like 10 days to lose your whole account, which is $100. So that's how it works. So now, if you are taking, let's say if you are taking 10 trades in a day, that means you are risking 1% on each trade. So if all the trade goes against you, that's why you are losing just $10 from your $100 account. So you still have 9 more times to lose the remaining $90. So that is very, very important. You must also note down your maximum number of trade per day. My whole maximum number of trade per day is just two trades. I might say, okay, I'll be trading just 2 times today. If my first setup didn't work out, then I'll try again. But if my first setup works out, I'm done for the day. So I can only take 2 trades if the first one goes against me and I see another clear setup. I might decide to, okay, I want to trade again. So very, very important. You must first of all determine how much you want to risk per trade, how much you want to risk per day, and how much number of trades are you taking per day. So these core major things must be noted in your risk management rules in your trading plan. The last one, which is number seven, is no trade conditions. That is knowing when not to trade. This is very important in your trading plan. You must not joke with it. Like you must not trade when you are emotionally stressed for the day, or you must not trade. It's not every trade you must jump into. Avoid the market when your strategy or your setup is not present at that moment. You must not jump into every trade that you see. Then for those that are not good with fundamental analysis, you must not trade news. Whenever there is high volatile news like the NFP, CPI, FMOC, avoid the market at that moment. So you must not trade for the day. Knowing not when to trade is very, very important in your trading plan. So thanks guys for watching to this point. If you find value in this video, kindly subscribe and hit the like button so that you can have access to my next video. Thank you.